Hello there everyone, thanks for tuning in. This is Matt Curfman with the January 2019 edition of Matt's Minutes. Well, we're starting to see a little bit of relief, I guess would be the word, in the month of January. Before we get too far into the new year, I wanted to add some perspective, some more data that came out right around the first couple of weeks of the year to just kind of highlight and show what happened in the fourth quarter. Broadly speaking, if you look at the fourth quarter, and some of these topics repeat from my December, but you saw the Dow Jones, the S&P, and the NASDAQ effectively over the fourth quarter off between 12.4% and 17.4%. And so those are really extreme numbers. Then if you highlight just the month of December to give you some perspective of how choppy and negative the month of December was, to find another December like we went through, you actually have to go back into the Great Depression. Yes, I said that correct, the Great Depression. So December of 1931 is the last December we can find that would be comparable to what we all just went through. What's even more ironic about that is we're not tipping into recession. We're certainly not in a Great Depression. And so that gives us some tools to say we think fear took over the markets in the fourth quarter. Fear doesn't usually hang on that long. And so we're starting to see some of that recovery in January. A couple of two or three things that are kind of hanging over the markets. One, the Federal Reserve and the interest rate policy. As many of you know, the Federal Reserve has been raising interest rates during the year of 2018. In December, they came out and basically said they expect to have a consistent increase in rates in 2019. That was not received very well, so the chair of the Federal Reserve came out in early January and basically indicated that they're willing to be flexible based on economic conditions. The market really enjoyed hearing that. Keep in mind on interest rates. Interest rates are going up because the economy is strong. Historically, the last time we have arguably had massive increases in interest rates, you have to go back to the Jimmy Carter days, late 70s and early 80s. Back then, the 10-year Treasury hit 15.84%. And literally up until about 2008, rates have been dropping until about 10 years ago, where you could argue they've been near zero for close to a decade up until 2018. So we're in a rising interest rate environment. That scares people, but it's almost like in winter in Michigan. Every year it snows, and every year, I'm sure none of us are the bad drivers, but there are bad drivers that come out, and we forget that we drove in snow just a year ago. So imagine that you hadn't driven in snow for 30 or 40 years. You wouldn't know how to act. You would probably not be your normal self, if you will. And that's what's happening, we think, with interest rates. So remember, rising interest rates is a sign of a good economy. Second, we've obviously had the government shutdown going on. That creates uncertainty. It was the longest government shutdown on record. And so what I would say right now is we're in a to-be-continued phase up until February 15th, and then we'll see what happens from there. Lastly, the U.S. and China trade relations, and then the idea that China's economy is slowing down. So to put some perspective to the Chinese economy, in 2017, their GDP, gross domestic product, came in at around 6.9% for the year. And if you look at 2018 expectations for the previous year, they're expecting somewhere between, let's just call it 6.6%. So is 6.9 down to 6.6 a reduction? Yes. Is that a massive declining and decelerating economy? The answer is no. To give you perspective, U.S. GDP is anywhere in the range of 2 to 3%, depending on which forecaster you look at. And so their economy is still 2 to 2.5 times per year faster and more growth-oriented than the U.S. economy. So that's not really a major concern when you look at the data. On all of these three things, interest rates, the U.S. and China trade relations, and the government shutdown, whether we agree, disagree, or it's positive, neutral, or negative, when there is an outcome, that will provide relief to the markets, and that will probably be a very positive sign for the markets. So kind of keep that in mind. Earnings season for the year end of 2018 is upon us. Corporations are going to start releasing their earnings for the 2018 year. And we do expect GDP in the U.S. to be in the 2 to 3% range for the year, which is a growing number. That's important to understand. Year over year, if you look at corporate earnings, we're going to eventually in 2019 get to a point where when you look at a period in 2019 and you compare to that same period in 2018, we will eventually start to see earnings growth slow down. And when that slows down, that does not mean we're tipping into recession. It's just that numbers were so high in 2018 in the early part of the year. So keep that in mind. And as we move into 2019, some data was released that basically says there are 13 recession indicators out there. And as of the first week in January, 12 of the 13 recession indicators do not give any signal that we are tipping over into recession. And in fact, 4 or 5 of those are not only positive, but they're growing, they're accelerating. And so that's the data we want you to be aware of. Why is that important to you? Because that data helps us guide decisions with respect to the equity bucket, the portion of your portfolio that is the most volatile. And so if you look at the chart that I've shared here on the screen, if you saw Matt's Minutes last month, you probably remember this chart, and it's titled, "And This Is How Not to Do It." I added some notes to this to give you some perspective about where Richmond Brothers thinks we are in this cycle. If you look at the trough, which is the bottom of the dip in kind of the roller coaster, I put in there that that might have been Q4 of 2018. So, because all the data indicates the economy is not tipping into recession, we do think 2019 has the ability with the equity bucket to have some recovery and actually have some growth. So as we have that growth and we kind of get over to a peak again, if we think recession is coming in 2020 or 2021, what we want to be doing is when we get near the top, we're never going to be able to call the top, but on the way up and somewhere along the top, that's where we want to be skimming off the top or reducing some of your equity exposure. And if you take income, making sure we're trying whenever possible to do forward income planning for between 1 year and maybe 4 or 5 years, depending on how conservative we want to actually be. So we want to let you know what our thought process is. And so we think 2019 again has the ability to come up, and then we will have the ability to continue skimming from the top, reducing individual equity exposure, continuing to get more broad-based, and that way it adds more balance and more consistency into all of your portfolios. So keep that in mind, and as always, if you have any questions, don't hesitate to reach out to us. You can call us or email questions@richmondbrothers.com. Thank you so much for tuning in, and for those of you in Michigan, stay warm these next couple of weeks. We're going to have negative temperatures, which will be the high for the day. We appreciate the opportunity to work for you, and thank you so much for allowing us that.